pleasure to introduce David Bassanese from BetaShares. David is a, let me just make sure I don't demote him. David, as you'll know, is a extremely well-known economist, widely reported, with a focus on advice. David, I'll let me just move on to the market outlook. David's going to talk about BetaShares' view of the market as we currently find it. Again, if you have questions for David, use the Q&A button at the bottom of the screen.
Great, thanks very much, Toby, and thanks everyone to joining us today. Very unusual circumstances, of course. You know, many of us are now working from home during these lockdowns. So what I'll do today is really just 15 minutes, just a quick run through of how I'm seeing the financial markets, the economic outlook, and you know, again, as BetaShares, we're an ETF provider. We do provide over 60 exchange traded funds now. We also do run a model portfolio service that includes some of our ETFs and some other non-BetaShares ETFs within our model portfolio. So a lot of what I'm talking about really is the thematic underpinning our current dynamic asset allocation within our models. And as you'll see from what I'm saying, we're actually still quite defensive. We're a little bit due. Our investment committee suspects that we're going to see more equity weakness ahead. We think the markets have got a little bit ahead of themselves. But on that point, I'll just talk to a few slides. And as we can see, if we just go to the first slide, So really, the point here is the challenge of the coronavirus, and that this just compares different, I guess, disease outbreaks in terms of their contagiousness, the sort of reproduction rate, the number of people that do get infected will tend to get infected by different diseases versus the fatality rate. So the COVID-19, according to best estimates, has a fatality rate of around about 1%. I mean, there's lots of different results in different countries at the moment, but the best guess, it's around about 1%, which is, again, 10 times worse than the common cold, and enough that, if left unchecked, would overwhelm the hospital systems, lead to an overwhelming of ICU units and whatnot. So that is the challenge. And again, unlike, say, the swine flu of 2009, which was quite widespread, that was widespread, but it didn't lead to the death rates and the hospitalisation rates. And so, in a way, it wasn't as negative for markets or the economy. SARS also, back in 2003, the death rate for SARS was higher, but the symptom, when you did get SARS, basically you knew it pretty quickly, and it was able to be contained fairly quickly within Asia before it spread a lot wider around the world. So the challenge of COVID is that it is quite infectious, and it's deadly enough that, left unchecked, can overrun the hospital system. So as we see with the next slide, as you can see with the next slide, I mean, this has been the challenge for policymakers, is that the scientists is telling us, left unchecked, the virus would really overrun the hospital system. In this case, it's the ICU capacity of the United States, but it's a similar situation around the world. I mean, hospital systems, ICU capacity in countries around the world aren't designed for pandemics. I mean, you don't build out that sort of capacity just for one in a century type occurrence. And so, left unchecked, the hospital systems would have been overwhelmed. We did see cases of that in New York and in the UK to some extent. And so the solution has been to go into lockdown. And as you can see, with the lockdowns, the idea is you can flatten the curve, reduce the peak demand on the system. Now, this is from a modelling from the Imperial College of London. It's informed the UK debate, but many scientists around the world are coming up with similar conclusions. Now, the problem with that projection, as you can see, is it does involve lockdown for several months, more than markets are actually anticipating. So this UK simulation is talking about effectively social distancing measures in one form or another for about 5 months. And thereafter, once you come out of it, there is always that risk of a second wave of infections. And the hope is that by the time you come out of it, you'll have better vaccine treatments or be able to test, basically be able to get on top of it a bit better next time around by testing people, quarantining people, tracing them, and therefore not needing to go into social distancing and lockdown restrictions. But that is the challenge of the markets at the moment, is that lockdown's all well and good. We seem to flatten the curves. But if we don't do anything else, then as soon as we lift the restrictions, according to our best guess of the seriousness of this virus, that it will lead to second round effects or second waves later in the year. In terms of the economic impact, if you just go to the next slide, this is from the Federal Reserve Bank of New York. It's the blue line there is a summary of high frequency short-run indicators of the US economy mapped across US GDP growth. The bottom line is that indicator now is incredibly weak. You're looking at a downturn in the US economy, at least in the June quarter, much worse than we saw during the GFC. And some numbers are suggesting annualized decline in US GDP of around about 25 to 35% in the quarter. Now, what I would say is markets are pretty much that is, most economists do accept that now, and you would think the markets are pricing that. But the big debate is how quickly the economy can bounce back from that downturn. And again, the situation in Australia not too dissimilar, looking at quite a weak GDP in the June quarter. Hopes of a bit of a recovery in the September quarter, but therein is the debate at the moment, is exactly how quick things can recover. In terms of what this means for the equity market, if you just go to the next slide there, what I've got there is the downturns in the US S&P 500 index. So these are bear markets. So these are periods in history where the market has fallen by more than 20%, as defined by a bear market. I've split them up between periods without recession and periods with recession. And as you may know, in the US, there's a group called the National Bureau of Economic Research that can date recessions to the month. They typically don't tell us that immediately. It takes a year or so before they make that conclusion, but it does give us a historical reference point to say, well, these are periods where the US has been in recession, where it hasn't been. I think it's pretty clear that that decision hasn't been made yet, but it's pretty clear the US is in recession, or will be defined as being in recession. So it's really that first chart that's relevant. And as you can see, during recessions historically, it usually takes a while for markets to find a bottom. The average length of a bear market during recession periods in the US is about 12 months, or a little bit over 12 months. And really bad recessions, you've seen declines in the markets of around about 50-odd%. So at the moment, the market at its low dropped 35%. We've now had this, which was really the fastest decline into a bear market in history. We've now had a rebound in the markets, as you can see from the light blue line there. And again, it's the fastest rebound in the markets since 1938. So it's been quite an exceptional period in markets in terms of volatility. The steepest decline and one of the fastest rebounds we've ever seen. Now, if there is a V-shaped recovery, markets, are probably right, and they've put in a bottom. But anything less than a V-shaped recovery, if the recovery in the US economy and around the world is somewhat delayed, then there is a very good risk that this will only be a bear market bounce, as we've seen in the past. And again, if you look at previous episodes, there are clear examples where bear markets, they don't just fall in one go. You do get these rebounds and then retest the previous lows. Now, one of the challenges for the market in the US, and this is what makes me particularly cautious at the moment, is if we just go to the next slide, I'll just sort of talk my way through this. Now, the bottom of that slide is earnings expectations in the US. So the dark line is what's called forward earnings, and it's a weighted average of expected earnings for the current calendar year and for next year. And basically the way it works is it's a weighted average of earnings this year and next year, and the weight we attach to earnings next year, or 2021 earnings, increases as we get closer to that year, such that forward earnings will actually equal the market's expectation for calendar year 2021 earnings as at the end of the year. At the moment, it's an average with a bit more weight on 2020. But the bottom line of that is that, as you can see, analysts have been downgrading their earnings expectations already in line with the downturn. And I'm factoring in more downgrades over the next few months, such that earnings in 2020 will decline, I think, by around about 30% at least on 2019 levels, which is what we saw in the previous 2 US recessions. And it could even be a lot worse than that. So that's only in line with the previous recessions. And even if you factor in a 20% rebound in earnings in 2021, just the fact that 2020 is declining will drag down next year's level of earnings as well. Bottom line of that is that forward earnings for the market are likely to continue to decline for the next few months. Meanwhile, the market is now trading at a price to earnings ratio of about 18.5 times earnings, which is close to the peak levels that the market was at before this decline began. So the market in the US was at 19 times earnings at the peak of the market in mid-February, and now it's at 18.5. Now, even if the market stays at current price levels, and we get this decline in forward earnings over the next few months, it would mean that the market's PE ratio will rise from around about 18.5, potentially up over 20 to 25 times earnings, which is a level we haven't seen since the dot-com bubble over 20 years ago. So that is a big valuation for the markets to be able to hold. And again, so anything other than a V-shaped recovery in the US economy, I think that valuation will just be too rich for the market, and the market will need to adjust to, the likely continued downgrades to the earnings outlook over the next few months. And if you just go to the next slide, I mean, the Fed is trying its hardest to support the economy. If you look at the balance sheet of the Fed, you're now looking at $6 trillion on the Fed balance sheet, so well in excess of what they did during the GFC. So they've been very, very aggressive in supporting liquidity in the financial markets, supporting the bond markets. They haven't yet crossed the Rubicon in terms of buying into the equity market. I mean, some of the bulls out there suggest that the Fed won't let the market crash. If need be, it will actually step in and start buying equities. I don't think they'll go that far, but B, even if they did, if the situation was worse enough, I don't think the Fed acting would actually stop the market from falling. And we've seen examples in the past where central banks in China, particularly a few years ago, started buying into the equity market and the market just fell even harder. And similarly, Bank of Japan has bought into the equity market, and that hasn't stopped the market having its declines as well. So I wouldn't count on the Fed, supporting the market if need be, should it have a relapse. What we have seen, again, just another, I guess, somewhat worrisome feature at the moment. If we just go to the next slide, I mean, one of the benefits of saving graces of the US economy at the moment is the fact that the tech sector, and I'm talking about Google, Amazon, Facebook, Netflix, just to a lesser extent. The tech sector, which has been the most important sector during the bull market, and it's the most important sector in the US economy at the moment, has been least affected by the shutdown. So you've seen a gravitation of investors flocking to the tech sector during the recent market pullback, and such that the top 5 companies now account for around about 1/5 of the market cap of the S&P 500. So you've had a massive crowding into the tech area, which again I think makes the market a little bit vulnerable, because these companies themselves, I think, will need to downgrade their earnings outlook over the next few months, because consumer spending is going to be weak and advertising budgets are going to be slashed as well. So it's making the market, it's an unhealthy situation where so few companies account for such a big chunk of the market at the moment. Another thing to bear in mind, if you look at the bond market, just going to the next slide, US 10-year bond yields, again, if there was a V-shaped rebound coming, you would have think bond yields would have sold off more than we've seen to date, but US bond yields still remain very, very low. Now, the Fed supporting the market is helpful in this regard, but I think there are a lot of confidence about a growth rebound, you would see bond yields selling off somewhat more than we've seen to date. So bond market's usually pretty good at sniffing out, upturns and downturns in the growth outlook ahead of the equity market. So I think that's a bit of a telling sign in terms of how the market may well, the economy may well progress over the next few months. Looking at credit spreads also, again, so with the economic downturn, you've had a major blowout in credit spreads in the US. So this is the high yield credit spread in the US. It has come in with the Fed supporting the market, but as you can see, that spread is still very, very wide compared to where we were prior to the crisis. So credit spreads remain quite elevated, again, suggesting all is not well with the US economic outlook at the moment. And again, if you factor in the combination of high corporate credit spreads with the very high valuations in the equity market, it does suggest the equity market is looking a bit vulnerable. One asset class that has done reasonably well with the sell-off to date, and I think actually could continue to do well even with a market rebound next year, is gold. And again, around the world, central banks are going to keep interest rates very low, and potentially start targeting bond yields, doing like so-called yield curve management, where they basically, as we're seeing in Australia, for example, the Australian government, Reserve Bank is targeting 3-year bond yields to be no more than 0.25%, and the RBA stands ready to buy as many bonds as it needs to keep that yield no higher than that level. So effectively what they're doing is monetizing some of the budget deficit at the moment. So the governments are issuing bonds, they're selling them to the financial markets, and the RBA is buying some of those bonds back off the financial markets. And look, to the extent other central banks may start to do that sort of thing next year, the debt monetization, it's really going to be supportive of gold prices. And so, for example, in our model portfolios, we do have an opportunity to allocate to gold, and we've availed ourselves of that by having some exposure to gold within our defensive assets at the moment. And we think that's a reasonable defensive position given the extreme situation we're in and the likely behaviour of central banks over the next little while. There are some hopeful signs on the it's not all doom and gloom. I mean, China bears watching. They're the city of Wuhan, which was the first affected by the virus, has opened up again. Gradually, it's all not back to normal, but you are seeing signs of people back on the streets, activity picking up. And if there is an upside risk, it's that what we're seeing in China. Hopefully China doesn't get a second wave of infections, watching that very closely. I mean, if they do get a second wave and they need to lock things down again, that would be devastating for global financial markets. But, at this stage, at least, there's no signs of that, or very little sign of that. And so that's a positive sign going forward that China is at least recovering. But that recovery will also be constrained at the moment because its export markets are still, such as Europe and the US, are under pressure. The other thing to bear a watch on, which could lead to the, more upside risks, is better news on the drug front. And just a chart there showing all the various drugs that are being tested at the moment. A vaccine would ultimately be the solution here, but that's still, again, the best experts suggest that's still at least 12 months to 18 months away. But what we may see is some drugs that can at least treat the symptoms, so that if we do get second waves, maybe people can, get better drug treatment and not block up the hospitals as much as they've done during the first wave of infections. But unfortunately, the evidence on the drug front is still quite mixed. And there's been a few studies that recently come out that some of the hoped for drugs actually not as effective as we initially thought. So it's still quite mixed evidence on that regard. But again, if you're looking for a hope and a potential V-shaped scenario, that would be some sort of breakthrough drug outcome over the next few months. In terms of scenarios, just to conclude, I mean, everyone's talking about the various scenarios, the V, the U, the L. I mean, the worst case scenario would be that we basically open things up again, but we get a second wave. In fact, we get repeat waves. And, some scientists are saying we could have repeat waves of this virus until such time as the vaccine is available, which would be an absolutely devastating outcome. The V is where we open things up, we don't get a second wave, a miracle drug is available within a few months, and things can get back to normal, by the June, if not December quarter. I still think that would be consistent with the market retesting its lows, or at least having a decent pullback from where we are, but maybe not going through those lows in a big way. But my base case is really this U, that the conditions will be lifted gradually, the social distancing provisions will be lifted gradually, And even in that environment, consumers and business will remain cautious. And so we're going to have a very big decline in the earnings outlook that markets will need to factor in over the next 3 to 6 months. That's pretty much it from me. Happy to take any questions, should there be any.
Yes, so thanks very much, David. As I mentioned at the start, if you have questions for David, use the Q&A button at the bottom of the screen.